equation. This refers to our assets equals liabilities plus owner's equity. So that's the basic accounting equation. However, as we move through our transactions, we need to start looking at the individual accounts. So as you can see here, we have assets equals liabilities and owner's equity here at the top. But then we start to break out what accounts fall under each category. So my cash, accounts receivable, office equipment are for assets. My liabilities, accounts payable, and my owner's equity is my capital, withdrawal, revenue, and expenses. Because as we know now, these four accounts are an umbrella for owner's equity. They all affect owner's equity, so we're going to put them under owner's equity. Each of these lines does not necessarily mean that you're going to have something on each one of those lines. All we are looking at is our transactions. We're going to do analysis. What's happening? What accounts are involved? What's happening to those accounts? And where are we placing it in our accounting equation? So for example, our first one is that the owner invested $25,000 in cash. So on line A, we're going to say, okay, the owner is investing $25,000 in cash, so I'm going from $0 to $25,000. So that's an increase. I'm going to put plus $25,000. His capital went from $0 to $25,000, so I'm going to put plus $25,000. My balance at this point in time is $25,000 for cash, 0 for accounts receivable, 0 all the way across, and $25,000 for capital, and then 0 in the rest of these, because we have not affected those yet. So my accounting equation is in balance. My assets equals my liabilities plus owner's equity at $25,000. So then the next transaction, we purchase office equipment on account. So my office equipment is now going from 0 to $2,500 because I have now purchased office equipment in the amount of $2,500. I'm also increasing my accounts payable because now I owe somebody at some point in the future. So those are the only two accounts that are affected in that transaction. I don't have to look at anything else other than that. So now my next thing is to balance this out. So I have $25,000 for cash, still nothing for AR. I now have $2,500 for office equipment. I now have $2,500 for accounts payable, and I still have the $25,000 for capital. And then 0 the rest of the way down. Oops. Okay. And if I add this up, my accounting equation is in balance. Okay. And then we'd move on to the next transaction. We provided revenue or services, and we were paid cash. So what happens? My cash is going to increase by $800, and my revenue is going to increase by $800. Then I would now go ahead and balance out my accounting equation. So this is how we deal with an expanded accounting equation. Not every line needs a number. It's only what accounts are affected by that transaction. So you have to look at each transaction along the way and decide what's happening, what accounts are involved, and the impact to those accounts. So I could be increasing 2 accounts, I could be increasing one, decreasing another. It all depends on what accounts are involved and what the transaction is. So don't get wrapped up into it has to be a plus and a minus, because that's not necessarily true. Okay. So this again is the expanded accounting equation.